Hey everybody, welcome to this free edition of our Trader User Group for the trading week ending October 13th, 2023. I'm Preston Brenton. Thanks for tuning in. Well, this week's theme is market chaos. I'll talk about that just a little bit as we go forward in time. But what I want to do is let's just take a look at this past week's performance. You can see here that it was kind of a mixed market. I mean, we had the Dow and the S&P up, NASDAQ and Russell down. Russell was really the one that was punished the most. Year to date, everybody's in the green except for the Russell. The Dow is just barely hanging on into the green. They were in the red just a little bit. We did see large cap value stocks outperform this week. We got some earnings beats as earnings officially kicked off with Citigroup, Wells Fargo, and JPMorgan, some of the big money center banks. It's kind of the unofficial start to Q3 earnings season. Their profits mainly got a boost from higher interest rates. But again, we saw the prospects of a widening war in the Middle East, and defense kind of boosted shares of defensive stocks that kind of weighed down airline and cruise operators, things like that. But the other big surprise that we saw, volatility, the VIX went up 10% higher on the week to close at 19.32, as you can see on the screen there. Now, the 20-year average of the VIX is around 19, but we've been sitting at about, as you saw last week's close at 1745 there on your screen. That was a little bit lower. A lot of this risk wasn't priced into the market, so we saw a big vol skew shift in the markets, even though the markets kind of was a mixed bag, not too ugly, not too sweet, just kind of middle of the road, barely going nowhere. But we did see that big vol pop. Normally you don't see a vol move like that from the 17s to the 19s without a substantial move lower, but we didn't see that this week. But it does show a shift in some of the investor sentiment as we're moving into the beginning of earnings. But with the widening crisis over in the Middle East, I think we're starting to see some of that priced in. Not a lot, but some of it. Seasonality, I think, is also going to exert some force on the markets. And the official strongest period of the S&P generally starts around the October 13th time frame through the end of the year. And if we go back to like the 1950s, the average move up from the second week in October to the end of the year is about 6.85%, right? And that's 70% of the time, and that's the average move. But what we're also seeing is that the mega cap tech, we call them the Magnificent Seven, they make up 29% of the S&P index. 29%. That would be Apple, Microsoft, Google, Meta, Amazon, the big four, I guess the fangs, throwing in Microsoft. But then we add in NVDA and Tesla. So those stocks make up about 29% of the S&P index. Now those earnings really start kicking off next Wednesday. So we're going to start to see the real movement in the markets when these guys come into play. Right? You can see the dividend yield in the S&P is at 1.61. 10-year Treasury, although off the highs, is still relatively high at 4.63%. PE ratio, the forward PE ratio is now inched up higher than the trailing 12 months, which would make sense. That's kind of where analysts are projecting earnings. All right, they're projecting Q3 earnings to be slightly flat to slightly in the green. That'd be the first quarter in 3 that we've had a year-over-year earnings growth in the markets. Okay, now we did get CPI data this past week. It showed core PPI, which that excludes food and energy, rising 30 basis points in September. That's just a little bit above expectations. And the surprise 2.7% increase in year-over-year core producer prices. It was the year-over-year. It was the highest since May. But we've got revisions also, and we saw the core CPI inflation come in pretty much with expectations, rising 4.1% year-over-year. So although it wasn't dramatically, it wasn't higher, it wasn't lower, just slightly steady, but that does show inflation is pretty sticky right now. Okay, and we did get this midweek, we got the release here in the U.S. of the minutes from the Fed September policy meeting, And that does confirm most policymaker shifts in their official thinking of leaving rates pretty much at the current levels. And a lot of them are starting to use the language that due to tighter market conditions with higher yields on the back end of the curve tends to lead to tighter financial conditions. So most officials agree that the Fed is going to shift communications from how high will rates go to how long will the rates stay at the levels that they're at. I think that's kind of what we're going to start to see. Keep in mind, we don't have another Fed meeting until the last day of this month and the first day of November. So in one of the unusual monthly meetings, we get a Fed meeting on November the 1st, right? That's when we get the next interest rate decision. But right now, the Fed fund futures is only pricing in about a 5.7% chance of a rate hike. And it was almost slightly at 30% of a rate hike in November about a week ago. And it's below 40% for December. I think it's in the 20s now for a rate hike in December. So those rate hikes are coming down. So it seems like just from what the Feds are saying in front of press conferences and speeches and things like that is not high will they go, but how long will they keep them at the current level that they're coming at. Okay. Now, one other thing that's kind of spooking the markets and driving rates higher on the back end of the curve is all these Fed auctions. They're auctioning off a lot of Treasury debt to pay off our deficits. We got huge deficits right now, over almost 6% of the GDP, which is unbelievable. That's just the deficit. And then our total debt to GDP is about 120%, which is crazy as well. So we're going to see over the next few years, whoever's going to be president, they're going to have to weigh the odds of, they're going to have to be more kind of an austerity kind of program, doing a lot of cutting, or just assume that we're going to live with higher inflation and interest rates being higher. So we'll see how that all shakes itself out. But you can just kind of see the performers for the week, the best and the worst. The best was energy, obviously, with oil up, with the problems in the Mideast, and the worst discretionary, because money was seeking safety this week, even though it was kind of a mixed bag. And then the annual sector performance hadn't changed for quite some time. Communication services leading the way, up a little over 26%. Utilities is bringing up the rear at almost 28% to the downside. Okay. Of course, if we come over to the European markets, take a look at them, you'll see it's mostly down. The FTSE is the only one that finished in the green for the week, but the Euro stocks, CAC 40 DAX, also in the red. Year to date, everybody's in the green. We did get, like we got for us, we got the minutes of the ECB September meeting, and it kind of revealed a solid majority of policymakers had voted for their key rate hike of 4%. Pretty much in line with what our Fed policymakers are saying right now. But Europe is a little bit weaker than the US, and the big economy over in all of the Europe, especially the 19 countries that make up the ECB, is Germany. And they're projected to shrink 40 basis points due to higher energy prices, weaker demand from major markets like China, because China's hurting right now. And that was from an earlier increase of 40 basis points. So that's an 80 basis point change from prior expectations. So that's going to hurt all of the ECB, especially Germany. Meanwhile, in the UK, they bounced back a little bit. Their GDP expanded 20 basis points after contracting 60 basis points in July. So it's still kind of a mixed bag over in Europe. And then, of course, if we go to the Asian markets, you look at the Nikkei, it was up huge for the week, up 4.18%, year to date, 23%, really strong in Japan. The yen is pretty weak. It's around 149.6 against the dollar. I do believe the Japanese are going to jump in and take control of that in the next month or so. They're probably going to start buying yen and selling the dollar. And obviously the dollar is up because of the regional conflict in the Middle East, potential war spreading, and global economy not doing that well. So that's kind of where that's sitting. And the World Economic Forum and the World Economic Outlook from the IMF was they raised their growth forecast for Japan to 2.2% 0% or 2%. Previously, they're at 1.4. So Japan seems to be figuring it all out right now. By the way, Japan is one of the few countries outside of China that's stimulating the economy because they've been trying for 2 decades to see inflation, right? So the IMF lifted their forecast for consumer inflation in Japan to 3.2% this year, and it was from a previous 2.7. Remember, Japan came out and said, we want to see inflation well over 2% for a year or two to see it hold before we start taking action to bring it back down again. So, it's taken them decades to get to this, but that's kind of where they're sitting. Meanwhile, in China, in the Chinese markets, you can see they were down for the week. Remember, they were closed all last week, so they opened up this past week after their Golden Week holiday. Consumers did not spend as much in the entire week as they did the prior year. So, and we did see exports, they're still down 6.2% in September from a year earlier. It was down 8.8% in August. Imports also shrank 6.2%, and the contraction in August was 7.3. So it's starting to find a bottom, but still in a contraction territory, which, if you think about it, that's also hurting Germany because they export a lot over to China, especially in the high-end goods and auto area. So that's kind of what I'm seeing over in the markets right now. I'm going to shift the screen. Let me take you over to the S&P 500 E-mini futures. Let me just get you guys over there. And then I'm going to show you the, it'll take about another 5 or 10 seconds to pop up on your screen. But now I'm showing that you should be able to see it. If you take a look at the screen here, you can see that we're pretty much hitting my targets. I mean, you can see we blew through my initial target, hit this target here right around 43.50, almost to the button, intraday low. Then we moved up. There's another little sticky wicket right up in this area here. And then longer term out, my target just happened to be just slightly below the 200 EMA. All right, and we kind of came right down on it. We moved up and we ran into trouble in a buzzsaw at the 50 EMA, and now we're back down. These little railroad tracks here from 43.50 to 4300 is showing where there's some resistance. Now, we are making lower highs and lower lows. And until we take one of those lower highs or lower low pivots out, then I don't expect a change in direction. You can see the MACD is showing no divergence, so that does mean any move up, the odds favor to roll back over. And this is exactly what we're getting. So we are running right along par for what I've been anticipating going all the way back to July. All right, so if you've been keeping up with my weekend free blogs for you guys, this is kind of at a high level what we're expecting, what I'm expecting. I do not expect this to come back up into this 4,500 area yet. I suspect we've got some more downside, possibly even taking out this prior pivot low here and coming down to around 4,200 near the 0.236 fib pullback point from the highs of this year when we were up 19.81% on July 27th. Again, these are the futures market. So a big driver in where we're going to be going here is just how earnings are going to, come out this next week. We get a lot of earnings this coming week. I mean, we do get a ton of banks. We get Schwab, Bank of America, Bank of New York Mellon, Goldman Sachs, Morgan Stanley, U.S. Bank Corp, Truist, and American Express. So this week is going to be full of those. But the real big one that we want to watch is on Wednesday. We get Netflix and Tesla. All right, those are the ones that makes up those 7 stocks that control almost 30% of the S&P. So we're going to watch those very closely. All right. And we get a few other, and those are just, earnings reports. We do get retail spending on Tuesday, but the earnings now for the next 3 weeks are going to help drive the narrative of where the near-term direction of this market is going to go leading up to the Feds on November 1st. Now, the markets are not expecting a rate hike, as I said. There's only like a 5.7% chance of a rate hike, like I indicated. But what the market's going to know or want to know is just where is or where are the Fed governor voting members thinking going out into Q4 and then Q1 and Q2 of next year. Now remember, this meeting on November 1st, we do not get the dot plot. The dot plot shows where they see interest rates over the next 12 or 24 months. We only get that at the end of the quarter. So that means the December meeting will get the dot plot. But remember what happened in the last meeting in September, the end of that quarter, we got the dot plot and it surprised the markets and we rolled over because the markets were expecting 4 rate cuts for 24 and the dot plot indicated really only 2 rate cuts. So the Feds really are not doing anything with interest rates right now. I think they're jawboning the market and trying to control through their voice where markets go. They don't want the markets too hot, but also because we've had that huge shift in the back end of the yield curve. The 10-year and 30-year bonds and notes are up a lot higher than everybody was looking at about 90 days ago. That's created a lot of tightening conditions in the market. So that's what's led the Feds to basically say we've got fairly good tight markets right now. Now, if you were to watch some of the TV biz shows, you'll see there's some analysts that are still calling for a rate hike and still calling for inflation. Other analysts are calling for a huge bull market. Now's the time to buy. So again, that makes a market, and we're going to see what it wants to do. Members, we'll go into more detail Sunday evening where I see some opportunities in the market. And for those of you following our special strategies, we're well up this year, and we're doing nicely with our option strategies. So we'll just kind of see how things pan themselves out. The thing I want to watch very closely, especially if you're an options trader, is watch volatility in the vol skew. Okay, we're going to want to watch that very closely. Now, and speaking of the vol skew, if I look at the front month vol skew right now as we closed on Friday, you can see we're like almost right in the right at zero. All right. Now we do get vol futures expiring next Tuesday. So that's, and when they expire, the VIX and the vol futures basically are equal to each other. So it's not surprised we're hovering around here. So let's go to the back month, which compares October and November vol futures for the skew. And if we look at it, you can see we're still fairly deep in the green. Look at that really wide, that big fast movement all the way up. And then we came all the way back down on Friday, right? Even though we closed down on Friday about 29 points in the futures, the skew got a little bit of a scare, right? And then if we go out and we look at the October-April spread, so we're comparing this month to April of next year, you can see the spread, again, a big move here. So all of these big movements is what's causing some of the skew shift in the market, all right? It tried to move up here early this month, and then it fell back down. And then on Thursday and Friday, we had that vol skew shift, and we moved up dramatically. So that just means on the back end of the curve, volatility moved up relative to the front end a lot faster. All right. So we're going to watch this closely. I'm going to watch it and just kind of see where it pans out. And of course, if we look at the bond market, you can see the bond market is coming right down to my target. My target was right around 107. We've hit 109, and it's in fact, let me just, I think we hit a lower level right here, right there. We hit 108.20, right? So, 108.29 is kind of that level right there. My target in this bar was right around 107, the midpoint. So we're coming in really close, not only from a timing perspective, but also from a price perspective, because it's price and time, not just price. And that my system uses a combination of Gann and Fibonacci to control and to guesstimate based on prior movement where the support element will be. And it does also incorporate Elliott wave too. So you can see it's an Elliott wave 5, but we do not have any divergence here. That does suggest that any movement higher in bonds is going to roll back over again. But I feel we've got fairly strong support here, short of any strange news hitting the markets. we should not bounce below this level, which basically tells me that the 10-year interest rate, you can see here my target for the 10-year interest rate is pretty close to being hit. And I do believe we did hit a high right here, and I just got to adjust it right like that level right there. That was the high. Let's just, I think it was a little bit higher than that, right? Right like that, yeah. So the high was 4,887. My target in the middle was right around 4.97, almost 5%. So you can see there is no divergence here. That would suggest that we are going to come up higher in interest rates, whereas the bonds are saying it should be scraping the bottom right now. So I've been forecasting for the rates in the 10-year to go up to 5. Now, if we get up there, you're going to see the equity markets, roll back over just a little bit, and that kind of goes in line with what I'm showing you guys on the chart. We still have a lot of risk through the end of this month, and that's kind of what I'm trying to get through to you guys. Okay. Of course, if we look at currencies, the dollar is strong in these weak times. I'm looking for the dollar to move up a little bit higher than the October 3rd high, all right, of a little over 107, which tells me the euro is probably going to roll over a little bit lower before we're ready to go long the euro. All right, you can see the euro has just come way undone, and we're probably going to get a cross in the 50 and the 200 on this. Okay. And then, of course, if we come down here and look at gold, obviously with the war and the expansion here, you can see gold just had a huge day. Probably going into the weekend, you can see gold just ripped higher, 62, almost 63 points in one day. We haven't had a move like that in gold in quite some time. So it does show some hedging in the market, okay? But you could see gold just going up. I would probably believe gold is going to give up at least 50% of Friday's gains, come back down and test the 50 and then maybe the 200 EMA. I've been short gold. My target for gold actually was right around 1850, and we moved a little bit lower than that. We actually went into the red for the year for gold. We moved slightly below the 2022 closing price of 1830, and now we're back up here again. I think we're going to chop around down here for a while, okay? And of course, if we look at silver, you're going to see the same thing. It ripped on Friday. We blew through my target at silver around 2150, but now notice we're kind of finding a little bit more resistance there in silver. So that's a little bit about what I'm seeing there. And of course, oil is also a potential hedge in any kind of war, because you can see how oil ripped higher as well. Now, my forecast for oil, it came right up and hit my forecast right here of around 95 a barrel. It hit 95.03, and I had this forecast up here months ago. Now, we hit it, we pull back, but you can see here that I'm looking for this thing to run back up again. Now, if this war in the Middle East spreads, oil is a good hedge. I'll see it hitting over 100. But if it does that, then I'm going to be interested in shorting oil. But right now, oil, you want to be neutral to bullish, right? I think that'd be a nice little play in the oil market as long as we got these issues. Now, another way to play it is just selling puts underneath 80. I think there's going to be a floor in oil around 80 as long as that war is going on right now. And it's at 87 right now. And you could do and members, I'll go through some ways that you can play this real nicely in the option market. So that's kind of where I'm seeing oil stacking up. Nat gas has just been a home run for us pretty much all year. And this is one of the freebies I give you guys on the weekend. Just selling puts underneath this thing, doing bull put spreads. And I've been talking about this going all the way back to May, right? Just bull put spread this thing all the way up. And that's all you've got to do. Now, once it gets outside this, I'd let it come back down in the bottom down here, find a little bit of support either in the middle to the lower end of this regression channel, and then put another bull put spread on. Okay. Just a couple of other things I want to show you, some of these other indexes. If we look at the Russell, the Russell's got a bear market chart, guys. This is a daily chart. The 50s crossed the 200. We're in the red clearly for the year. In fact, we're coming down. We haven't hit the lows for the Russell for this year. The lows were made on March 24th, but we're getting pretty darn close to it. You can see the MACD, there is no divergence there. That does suggest that we're probably going to be scraping around the bottom, but there's going to be a good trade coming out of this. And members, I'll review that with you guys when we get together for our weekly market watch Sunday evening. And then, of course, if we look at the Dow futures, right, it's in the green. You can see here, but we're hovering below the 200 EMA. So it's still a weakened chart, but not like the Russell. MACD suggests any move up is going to roll back over again. So we're in the Russell is the only one that's what I call an official bear chart. And that's when the 50 crosses the 200. Here we do not have that. The S&P, we do not have that. And then, of course, if we look at NASDAQ, let me just find that on the screen here. I know it's around here somewhere. Where are you? Here we go, right here. If we look at NASDAQ, you can see here it closed slightly below the 50 EMA. I think NASDAQ's going to come down and test these little railroad tracks here of price levels around 14,005, 14,006 area, testing this prior pivot low. You can see it's tested it several times, starting in end of September into early October. We moved up and then we made in a lower high here. So this could be a steady gate lower. In fact, my system's forecasting near term this to pull back and give up another 500 or 600 points, all the way for another 1,000 points lower going out to middle of December. That would suggest higher interest rates. And that would also suggest, remember, we got these magnificent 7 stocks, Apple, Microsoft, Google, Meta, Amazon, NVDA, Tesla, all coming out with earnings here pretty soon. And as I said, this week we get Netflix and Tesla coming out. So those are 2 big stocks also, not considered really part of the 7 Netflix, but it's still a large stock and it has a lot of sway in the tech sector. So this is kind of what I'm looking at, guys. Members, I'll see you guys this Sunday evening for our weekly market watch, 8 p.m. Sunday evening. If you're not a member, I highly encourage you to come in and check us out. We're having another fun year here. All right, everybody, have a great weekend. Members, I'll see you Sunday evening. Ciao, folks.